Welcome to the deep dive. Today, we are really getting into the weeds on how organizations figure out if they're actually succeeding, beyond just are we making money. We're looking at the whole structure of performance management and our source material. It lays it all out visually, like a blueprint for measuring success in, well, serious businesses. So our goal here is to get a quick, high-level grasp of this whole thing, understand the basics, the structure, and then crucially, how to calculate and interpret both the money metrics, the financial ones, and the other stuff, the non-financial indicators. Those really tell you about future health.
Right, and that blend, financial and non-financial, that's really the core of it. This deep dive shows you it's a balancing act.
Yeah.
Always. You're constantly measuring the past, the hard numbers, the financials, but you also have to drive the future, which often involves things that are harder to quantify, things that are more qualitative. It's about aligning the whole organization.
Okay, right. Let's dive in. Where do we start? The source kicks off with the philosophy behind it all. Objectives of performance measurement. But what struck me right away is it's not just one objective. It immediately introduces, well, complexity. Yeah, there are three key ideas right at the start. The objectives themselves, naturally, but then these two hierarchies, the performance hierarchy and the hierarchy of objectives. They sound really similar. It feels easy to mix them up. What's the actual difference there?
Yeah, that's a critical point. Get them confused and your whole measurement system, well, it just doesn't work right. Think of it like building a house, maybe.
Okay.
The hierarchy of objectives is like the architect's plan.
Yeah.
The what starts big picture, the CEO's main goals, then those filter down. Department goals, team goals, individual tasks. It's the strategy cascading down what everyone needs to achieve.
Got it. The what? So the performance hierarchy is...
That's more about the structure for managing and measuring. The who and the where. How does measurement happen across the company? From the board level down to senior managers, divisional leaders, right down to the shop floor. It's about accountability. So if the objective is, say, a high-quality roof, the performance hierarchy defines who measures the beam quality, the waterproofing, the nail counts at each step. It connects the vision to the actual work being checked.
Okay, that house analogy really helps. So objectives hierarchy is the plan. Performance hierarchy is the accountability structure for checking the plan. Makes sense. All right, so once we have the objectives and the structure, we need the actual tools, the metrics. Let's pivot to the traditional ones. Financial performance indicators, FPIs. This is where, the numbers come in, the calculation part. The blueprint lists 6 key groups of ratios here. Absolutely vital stuff to get your head around.
They really are. It's the standard language of business, isn't it?
Yeah.
If you're talking finance investors, banks, you have to use these ratios. And these 6 categories, they sort of fall into 2 main buckets, really. You've got metrics about profitability and efficiency, and then metrics about solvency and risk.
Okay, let's break those down. Profitability and efficiency first. The blueprint lists 1, returns to capital, 2, profit margins, and 3, asset turnover ratios.
Right. Those tell you how good the company is at making money from its sales and how well it uses the money invested in it. Returns to capital is maybe the most fundamental, right? How much bang for your buck are you getting?
Makes sense. Then the second group focus more on risk and stability. That's number 4, liquidity ratios. 5 is gearing. And 6, interest cover.
Exactly. And, while profit is great, sometimes the real story, the real drama, is in this second group. Take gearing. Super important, but often a bit misunderstood.
How so?
Well, gearing is basically your debt-to-equity ratio. It tells you how much the company relies on borrowing versus money from shareholders.
Okay, so why is that so critical? Why should, say, a manager or investor care so much about gearing?
Because it's your financial risk gauge. Simple as that. High gearing means lots of debt. Now, you might have fantastic profit margins right now, looking great, but if interest rates tick up, or your sales dip even a little, suddenly servicing that debt, which is what interest cover measures, by the way, your ability to pay the interest, it can become crippling, potentially bankrupting. It's definitely the metric that keeps leadership awake at night, balancing that aggressive growth, often debt-funded, against the risk of things going south.
That paints a clear picture. Okay, so we have these FPIs, detailed, precise, but looking backward. We can measure profit, efficiency, risk. But then, why does the blueprint immediately turn around and dedicate a whole section to the problems with FPIs? It seems counterintuitive.
Yeah, the source leads right into the weaknesses of FPIs. If these numbers are so hard and quantifiable, why look elsewhere? What's missing? Well, because like you said, they're backward-looking. They're history lessons. They tell you what happened last quarter precisely, but they give you almost zero clue why it happened or what's likely to happen next month. Did profit margin drop because of bad training? Slow machines, unhappy customers, The FPI won't tell you. And there's another problem. Relying only on FPIs. It pushes managers towards short-term thinking. It just does. You might slash the training budget or cut corners on quality control, maybe delay essential maintenance. Why? To make this quarter's profit margins look better.
Ah, right. Boost the numbers now, even if it damages the company down the road.
Exactly. You're trading long-term health for a short-term financial win. And that's often a terrible trade.
Which perfectly sets up the need for the other side of the coin, non-financial performance indicators, NFPIs. This is where we start measuring the things that actually drive future financial results, isn't it? Looking at the NFPI section in our source, you can see how it fills those gaps FPIs leave behind. It details specific tools going from broad strategic health down to the nitty-gritty operations.
Precisely. NFPIs are about quality, innovation, customer loyalty, employee skills, things like that. They're leading indicators. Think about it. If your customer satisfaction plummets today, your revenue will drop tomorrow or next quarter. An FPI only sees the revenue drop later. An NFPI helps you spot the cause much earlier.
Okay, and the source breaks this down further. It talks about KPIs, key performance indicators, first the really crucial ones, then it gets into operational NFPIs, and it also explicitly lists the advantages of NFPIs. So what's the real difference between a KPI and an operational NFPI? They both sound like performance metrics.
Good question. A KPI is generally more strategic, higher level. For example, achieve 95% customer retention. That's a KPI. It's vital for long-term profit. An operational NFPI is more granular. It's the metric used on the factory floor or in the call center to help achieve that KPI. So that might be something like reduce average customer call wait time to under 60 seconds, or maybe keep product defect rate below 0.5%. See? Operational NFPIs are the day-to-day execution metrics that support the big picture KPIs.
Right, the nuts and bolts versus the strategic goals. And the great thing about those operational ones is you can act on them immediately, can't you? If your defect rate, your operational NFPI is creeping up, you can investigate the production line right now and figure out ways to improve. It feels much more dynamic. Whereas if your returns to capital dip, it just tells you, oh, bad result, but not really where the problem is or how to fix it.
Exactly. And look at the other elements mentioned right there in the NFPI section. Ways to improve and target setting. That's the feedback loop in action. You measure the defects, the NFPI. That triggers defining ways to improve, maybe retraining, maybe machine adjustments. Then you set a new specific target based on those improvement actions. Shows NFPIs aren't just for reporting. They're fundamentally tied into executing strategy and making changes.
This whole deep dive really hammers home that proper performance management isn't just one thing or the other. It's about combining that financial scrutiny from FPIs with the forward-looking guidance you get from NFPIs. You need both for the complete picture. Okay, so let's recap quickly. We started with the foundation, the hierarchy of objectives, making sure strategy flows down. Then we got into the essential financial tools, the FPIs, understanding what things like returns to capital or liquidity ratios tell us about past performance and current stability. But we saw why that's not enough, which led us to NFPIs using KPIs for strategic focus and operational NFPIs for day-to-day execution, making sure we're driving future success.
So what's the big takeaway for you, the listener? I think it's that performance management is this integrated system. It's not just the finance department's job. It forces leaders to confront that tension between hitting short-term numbers and making the long-term investments needed for sustainable success. Adding NFPIs makes managers focus on quality, on customers, on employees, things that might actually cost money now, reducing profit margins slightly, but build that foundation for the future. And think about that last part we discussed. Our overview mentioned target setting within the NFPI framework, linking back to the performance hierarchy and the overall strategic goals. So here's something to chew on. Imagine you're a manager. You've got a hard financial target, let's say hitting a specific profit margin. But you also have a non-financial target that might conflict, like needing to significantly boost the training budget to improve quality, or implementing some costly ways to improve a process. How do you balance those? Do you hit the margin number at all costs, potentially sacrificing the long-term improvement?
Or do you make the investment, maybe miss the margin target slightly this quarter, but build a stronger future? Or can you find a way to do both? That constant juggling act, that difficult balance, that's really the core challenge and maybe the art of effective management. Something to think about as you use this kind of framework.